Options trading can seem complicated, but don't worry, we're here to break it down. Think of options as contracts. These contracts give you the right to buy or sell something later. This something is typically a stock. Options trading is a big part of the financial market. They let investors make different types of bets on stock prices. They can also be used to manage risk. Before you start trading options, it's crucial to understand the fundamental concepts and terminology that are commonly used in the options market. This knowledge will not only help you make informed decisions, but also enable you to communicate more effectively with other traders and financial advisors. You need to know the lingo. Options trading has its own set of terms that might seem confusing at first, but once you get the hang of them, they become second nature. Let's start with the underlying asset. This is the financial instrument on which an option's value is based. It could be a stock, an index, a commodity, or even a currency. Understanding the underlying asset is crucial because its price movements directly affect the value of the option. For instance, if you're trading an option on Apple stock is the underlying asset. The performance of Apple stock will determine the value of the option you hold. If Apple stock goes up, the value of a call option on Apple stock will generally increase, and vice versa for a put option. For example, if you're trading an option on Apple stock is the underlying asset. This means that the option's value is derived from the price movements of Apple stock. If Apple stock performs well, the value of your option may increase, giving you the potential for profit. The strike price is the set price at which you can buy or sell the stock. This is a predetermined price agreed upon when the option contract is created. The strike price is crucial because it determines whether an option is in the money, at the money, or out of the money. This happens if you decide to use your option. Exercising the option means you are choosing to buy or sell the underlying asset at the strike price. Whether you decide to exercise the option depends on the current market price of the underlying asset relative to the strike price. The expiration date is exactly what it sounds like. The last day you can use your option. After this date, the option becomes worthless. It's important to keep track of the expiration date because it affects the time value of the option. The closer you get to the expiration date, the less time value the option has. Finally, the premium is the price you pay to buy the option. This is the cost of acquiring the option contract and is influenced by various factors including the underlying asset's price, the strike price, the time until expiration, and market volatility. It's like an insurance premium. Just as you pay a premium for an insurance policy to protect against potential losses, you pay an option premium to gain the right, but not the obligation, to buy or sell the underlying asset at the strike price. You pay it for the right, but not the obligation, to buy or sell the stock. This flexibility is one of the key advantages of trading options. It allows you to hedge against potential losses, or speculate on future price movements, without committing to a full purchase or sale of the underlying asset. A call option gives you the right to buy the underlying asset. You buy a call option when you think the stock price will go up. Let's say you buy a call option for Apple stock with a strike price of $150. The expiration date is 1 month from now. If the price of Apple stock goes up to $170 before the expiration date, you can exercise your option. This means you buy Apple stock at $150 and sell it at $170, making a profit. Put options are the opposite of call options. While call options give you the right to buy an asset at a predetermined price, put options give you the right to sell an asset at a predetermined price. This can be a powerful tool in your trading arsenal, especially in a volatile market. They give you the right to sell the underlying asset at a specific price known as the strike price, before a certain date, known as the expiration date. This means you can lock in a selling price even if the market price drops significantly. You buy a put option when you think the price of a stock will go down. For example, if you believe that a company's stock is overvalued or that the market is due for a correction, purchasing a put option can be a strategic move to profit from the decline. Let's say you buy a put option for Tesla stock with a strike price of $250. This means you have the right to sell Tesla stock at $250 regardless of its current market price, up until the option's expiration date. The expiration date is in 2 months. This time frame gives you the flexibility to monitor the market and decide the best moment to exercise your option, depending on how the stock price moves. If the price of Tesla stock falls to $200 before the expiration date, you can exercise your option. This means you can buy Tesla stock at the current market price of $200 and then sell it at the strike price of $250. You buy Tesla stock at $200 in the market and sell it at the strike price of $250, making a profit. This profit is the difference between the strike price and the market price, minus the cost of the put option itself. In this case, you would make a $50 profit per share, minus any premiums paid for the option. Put options can also serve as a form of insurance for your portfolio. If you own shares of a stock and are concerned about a potential decline in its value, buying put options can help offset losses. This strategy is known as hedging and can provide peace of mind in uncertain markets. Understanding how to use put options effectively can enhance your trading strategy and provide opportunities to profit in both rising and falling markets. It's essential to stay informed and consider your financial goals and risk tolerance when incorporating options into your investment plan. Whether you're a seasoned trader or just starting, mastering the use of put options can open up new avenues for managing risk and capitalizing on market movements. Always remember to do your research and consult with financial professionals to make informed decisions. Section 5. The roles of buyers and sellers. In options trading, there are always buyers and sellers. The buyer of an option pays the premium and has the right to exercise the option. The seller, also known as the writer, receives the premium and takes on the obligation to fulfill the option contract. Think of it like a bet. The buyer is betting that the stock price will move in a certain direction. The seller is betting against them. Section 6. Exploring options trading strategies. There are many different options trading strategies available to traders and investors. Each strategy has its own unique set of rules, risk profiles, and potential rewards. Understanding these strategies can help you make more informed decisions and potentially increase your chances of success in the market. Let's look at a few common ones that are widely used by both novice and experienced traders. These strategies can be tailored to fit different market conditions and individual risk tolerances. Buying calls or puts is the simplest strategy. When you buy a call option, you are betting that the stock price will go up. Conversely, when you buy a put option, you are betting that the stock price will go down. This straightforward approach allows traders to capitalize on their predictions about market movements. This is simply betting on the direction of the stock price. If your prediction is correct, you can make a significant profit. However, if the stock moves in the opposite direction, you could lose the entire premium paid for the option. Therefore, it's crucial to have a solid understanding of market trends and factors that can influence stock prices. A covered call is a strategy where you sell a call option on a stock you already own. This strategy is often used to generate additional income from a stock that you believe will not move significantly in the near term. By selling the call option, you collect a premium, which can provide a steady stream of income. This generates income, but it limits your potential profit if the stock price goes up significantly. Essentially, you are giving up some of the upside potential in exchange for the premium received from selling the call option. This strategy is best suited for stocks that you believe will remain relatively stable or have modest gains. Protective put buying is a hedging strategy. This involves buying a put option on a stock you already own. The primary goal of this strategy is to protect your investment from significant losses if the stock price falls. By purchasing the put option, you have the right to sell the stock at a predetermined price, which can help mitigate potential losses. You buy a put option on a stock you own to limit potential losses if the stock price falls. This strategy acts as an insurance policy for your investment. While it does require paying a premium for the put option, the protection it offers can be invaluable, especially in volatile markets. Spreads involve combining multiple options contracts. There are various types of spreads, such as vertical spreads, horizontal spreads, and diagonal spreads. Each type of spread has its own unique characteristics and can be used to achieve different trading objectives. This creates a defined risk-reward profile. By using spreads, traders can limit their potential losses while also capping their potential gains. This strategy is particularly useful for managing risk and can be tailored to fit specific market outlooks and risk tolerances. Understanding the nuances of different spread strategies can help you make more informed trading decisions. Section 7. Benefits of trading options. Options trading can offer several benefits. One key benefit is leverage. With options, you can control a large amount of stock with a relatively small investment. This can lead to significant profits if you're right about the direction of the stock price. Options can also be used for hedging. They provide insurance against potential losses in your stock portfolio. Finally, options trading can be used for income generation. Selling covered calls on stocks you own can generate premium income. Section 8. Risks and considerations in options trading. While options trading offers potential rewards, it also carries risks. One major risk is time decay. The value of an option erodes as the expiration date gets closer. Options are also affected by volatility. Large price swings in the underlying stock can impact option prices significantly. Options trading can be complex and requires a solid understanding of the markets. It's important to understand the potential risks and rewards before you start trading. Section 9. Conclusion. Navigating the world of options. Options trading can be a powerful tool for investors, but it's essential to remember that options are complex instruments. They require careful consideration and a thorough understanding of the market. Before you dive into options trading, do your homework. Understand the risks and the rewards. And remember, never invest more than you can afford to lose.